Exercise 2.5 is asking us to look at this information and produce two income statements, one in the traditional format and one in the contribution margin format. So let's take a look at the stuff that we're going to need no matter what. First, we're going to need to figure out the revenue. So the revenue here is $10 or 10,000 units at $15 per unit. So our revenue is $150,000, and that's not going to change. And we need to figure out our cost of goods sold, and that's not going to change because cost of goods sold is the variable cost per unit times the units sold. So in this case, it's going to be the same. We have beginning inventory of 12. We have 90 of purchases, and we have 22 ending inventory. So our cost of goods sold is beginning inventory 12 plus purchases 90 minus our ending inventory 22. So that gives us a total cost of goods sold of $80,000. So we're going to need those numbers no matter what we do. So let's start with those. We'll fill those in, and then we'll see where the differences are. So let me back this off a little bit so you can see the whole sheet. And remember, we said our sales are going to be the same. It doesn't matter which method we used. So the sales is still going to be $150,000 in either case. Our cost of goods sold is going to be the same in either case of 80. Our gross margin under the traditional format is 70. We then have our selling expenses and our administrative expenses. Now, under the traditional method, we include both variable and fixed, so we're told that we have $2 per unit variable selling plus 20,000 fixed. That gives us 40,000 fixed, or 40,000 total selling expenses. And the same with administrative expenses. It's $1 per unit times 10,000 units plus the $15,000 fixed. Together gives us 25,000, excuse me. So our net operating income is 70 minus 65, 5,000. And when we're done, that's going to be the same, irrespective of the method we choose. The difference is the pieces in between. So let's take a look now down at the contribution margin statement and highlight some of those differences. Well, the first thing to highlight is the fact that in the contribution margin, we have total fixed expenses and we have total fixed administrative expenses. Okay, and they're put together, and our total fixed expenses, our selling expense is 20, and our admin is 15, so they're fixed. Okay, when we're all done, we have $35,000 of fixed expenses, and we're going to treat those as fixed expenses. We're now going to take a look at our selling expense and our administrative expense, and we're going to look at the variable portion of those. Well, the selling expense, we're told, is a variable selling expense of $2 per unit, 10,000 units, that's $20,000. And our administrative is 10,000 units times $1, that's 10,000. So altogether, that gives us 110,000 variable expenses, which leads us to a contribution margin of 40,000. We subtract our fixed expenses and we end up with net operating income of 5,000. They will be the same, always. The only thing that changes is how you get there.